Let me give you the headline first, because the math I am about to share with you is terrifying. The Comex, the primary exchange for trading silver futures in the United States, currently has between 103 and 120 million ounces of registered silver. That is the metal that is actually ready and available for physical delivery. Now, look at the other side of the ledger. The open interest on that same exchange stands at approximately 429 million ounces of contracts. Let me repeat that because the implications are structural, they have roughly 110 million ounces in the vault. They have 429 million ounces promised in contracts. That is a ratio of nearly 4-to-1. 4 ounces promised for every single ounce that actually exists. This is a game of musical chairs played with billions of dollars of wealth. And the music is about to stop. This is veiled wealth. And today, we are going to look at the potential structural break in the precious metals market and why the 38% crash you just witnessed might be the final bear trap before the vaults run dry. This is veiled wealth, and what I am about to share with you today could be the most important silver update you watch all year. The data coming out right now is unlike anything we have seen in decades. We are looking at a market that is fracturing into two realities, the paper reality and the physical reality. Before we go any further, I want to hear from you. Drop a comment right now telling me where you are watching from. Are you tuning in from the United States? From Europe? From Asia? From Africa? I want to know where our community is located around the world because this is a global event. And while you are at it, tell me your prediction. What will silver do in the next 30 days? Will it crash further or will it explode? I read these comments and I want to know what your gut is telling you. Let me be crystal clear about something before we continue. I do not sell courses. I do not sell signals. I do not sell mentorships. I do not have any paid memberships. Veiled Wealth is about raw analysis. It is about presenting both sides of the market so you can see the complete picture and make your own informed decisions. I have received so many messages from you saying that this approach helps you understand what is really happening without the hype. That is exactly why I do this. If you want to stay connected with our community in real time, join our WhatsApp group. The link is in the description. Also, follow us on X, formerly Twitter. That is where I share quick updates when things are moving fast. Those are the only two places you will find veiled wealth. Protect yourself from scammers. Now, let us get into exactly what is happening and why this moment matters so much. Silver exchange-traded funds, ETFs, have crashed 38% from their all-time peak. This happened in just 7 trading sessions, 7 days, from record highs to a 38% collapse. The sharp reversal came after spot silver plummeted below $65 an ounce before staging a dramatic 8.6% recovery to $77.33 on Friday. This whipsaw price action tells you everything you need to know about the current state of this market. Extreme volatility, delicate positioning, and a war between the longs and the shorts. But what triggered this crash? 3 specific factors converged at the exact same time. Factor number 1, the margin weapon. The CME Group raised margin requirements for gold and silver futures for the 3rd time in just 2 weeks. Let that sink in. 3 times in 2 weeks. When the exchange raises margins, it isn't a suggestion. It is a demand. It forces leveraged traders to either put up more capital instantly or close their positions. Many cannot afford the cash call, so they sell. This creates a cascade of selling pressure that has nothing to do with silver fundamentals and everything to do with market mechanics. It is a forced liquidation event. Factor number 2, the Fed pivot panic. Hawkish Federal Reserve expectations following Kevin Warsh's nomination created massive uncertainty. Markets interpreted Warsh as a hard money hawk who might shrink the balance sheet. The algorithms read Warsh and sold metals. They bought the dollar. This macro headwind gave the shorts the excuse they needed to hammer the price. Factor number 3, the profit taking. When silver ran up to $120, a lot of optimistic positioning had already been built in. The trade was crowded. When markets are stretched like that, even a small whisper can trigger a massive correction. Here is what Harris F.A., head of commodity research at Geogit Investments, said about last week. Last week's steep plunge was driven by hawkish Fed expectations, a stronger dollar, and sharp CME margin hikes that forced leveraged unwinding. So, we have the official explanation. Margin hikes, Fed expectations, profit taking. That is the paper market narrative. But there is another reality playing out simultaneously, and it tells a completely different story. Let me ask you a logical question. If silver fundamentals are so weak that prices should crash 38%, why is it nearly impossible to source physical metal? If the paper price is correct, dealers should be flooded with inventory. People should be panic selling their coins. Supply should be abundant. But the opposite is happening. The gap between paper contracts and physical inventory has worsened dramatically. This is not speculation. This is documented fact. Multiple dealers have reported extreme difficulty sourcing physical silver. Some have shut down sales entirely because they cannot acquire inventory from the refiners. This happened during the COVID panic in 2020. It happened during the silver squeeze in 2021. And it is happening again right now. What does this tell you? It tells you that the paper market and the physical market are completely disconnected. One of them is lying. And when you look at the data, the physical market is screaming that paper is mispriced. Now, let us talk about the default scenario, because this is where things get potentially historic. The default scenario is based on that simple mathematical reality we started with. Comex has around 110 million ounces of registered silver. Open interest is 429 million ounces. If even 25% of contract holders demanded physical delivery instead of cash settlement, the exchange would technically run out of silver. 25%. That is the threshold. Recent activity shows that in January 2026 alone, an unusual 40 million ounces were ordered for delivery. 40 million ounces in a single month. If this pace continues or accelerates, the math becomes impossible. Some analysts are warning that by March 2026, Comex might run out of deliverable silver entirely. Clive Thompson has been particularly vocal about this timeline. His analysis suggests that the current rate of physical demand versus available supply creates an unsustainable situation within weeks, not months. And then you have the heavy hitters weighing in. Robert Kiyosaki, author of Rich Dad, Poor Dad, has stated he expects silver to hit $200 per ounce in 2026. His reasoning is based on a weakening fiat currency system, explosive industrial demand from solar energy and AI, and the fundamental supply deficit. Let me say that number again, $200 per ounce. Silver is currently trading around $77. A move to $200 would represent a gain of over 150%. Is this realistic? Let's look at the fundamentals. Silver is in a supply deficit. Demand exceeds mine production. This has been the case for years. Industrial demand is growing solar, EVs, AI. Mine supply is flat. Central banks are buying gold, which drags silver up. So the fundamental picture supports higher prices. But here is the skeptical case, and you need to hear this too. Critics point out that exchange rules prevent a full collapse. Comex contracts include provisions for force majeure and cash-only settlements. This means that if the exchange cannot deliver physical metal, it has the legal ability to settle contracts in cash. Technically, a true default where you get nothing might be impossible. Instead, you get a check. But ask yourself, if you ordered silver because you don't trust the dollar and they force you to take dollars, isn't that a default in everything but name? Price action matters regardless of the narrative. Silver is currently trading within the $71 to $80 demand zone. After the crash from highs above $120, price found support with a hammer formation near $64. This level aligns with the long-term 100-day exponential moving average. That is structural support. From a technical perspective, a decisive move above $80 to $85 would significantly strengthen recovery prospects toward $100. However, if we break below $71, the next major support zone is significantly lower. We could see a deeper washout. For those of you trading short-term, this environment demands rigorous risk management. The volatility we are seeing right now can make you rich, or it can destroy your account in an hour. Position sizing matters more than ever. If you are over-leveraged, you will be forced out of positions at the worst possible time, regardless of whether the long-term thesis is correct. For long-term investors, the stackers, the holders, this phase is about patience. The current fall is driven by market positioning and margin mechanics, not by a breakdown in the silver story. That is a critical distinction. Satish Dandapati, a fund manager, put it wisely. Yes, at current levels, investors can consider taking exposure to silver with a long-term perspective. Although prices have corrected, short-term volatility is likely to continue. But the fundamentals remain intact. The question many of you are asking in the comments is this a buying opportunity? Should you be accumulating at these levels? Here is my honest take. Historically, when silver corrects 30% or more from fundamentally supported levels during a bull market, it has bounced back. Every single time over the past several decades, severe corrections have been followed by recoveries to new highs. The fundamentals have not changed. Supply deficit? Still there. Industrial demand? Still growing. Physical scarcity? Worse than ever. What has changed is the sentiment. The weak hands have been shaken out. The leverage has been flushed. From a contrarian perspective, this kind of washout often marks the bottom, not the beginning of the end. But be careful. If the Fed remains hawkish, if the dollar strengthens, we could see one more leg down to scare the final bulls out of the market. Technical support at $71 must hold. So what am I watching specifically? Here is the veiled wealth watch list. 1. Gold price. Gold is near $5,000. If gold holds, silver will follow. 2. The gold/silver ratio, currently around 65. Historically, it averages 50 to 60. This suggests silver is undervalued. 3. Comex inventory. Watch the weekly updates. If registered silver keeps dropping while delivery notices rise, the squeeze is on. 4. Dealer availability. Can you actually buy metal? If not, the paper price is irrelevant. 5. Premiums. Are premiums in Shanghai and India rising? That shows real demand. 6. The dollar index. A strong dollar is a headwind. Watch it closely. Let me pause here and ask you another question. What is your time frame? Are you trading daily charts? Or are you investing for the next 5 years? Your answer determines your strategy. If you are a trader Volatility is risk. If you are an investor, this 38% drop is a gift. It is a time machine that lets you buy at last month's prices. Let me summarize where we stand. The Comex inventory situation is critical. 4-to-1 leverage ratio. If 25% stand for delivery, the system breaks. March 2026 is the key timeline to watch. The fundamental supply deficit, solar, AI are screaming buy. The mechanics margin hikes. Fed fears are screaming sell. This battle will be won by the side with the strongest hands. Paper can be printed. Margin rules can be changed. But physical silver cannot be printed. It must be mined. And right now, it is not being mined fast enough. I want to thank you for being here and for being part of the Veiled Wealth community. We are growing every day because people want unfiltered analysis, not polished hype. If this video helped you understand what is happening, share it with someone who needs to see it. Subscribe if you have not already. Join our WhatsApp community for real-time updates, link in the description. And remember, investing is about logic, not emotion. Use your brain. Have a plan. And don't let the volatility shake you out of a generational asset. This is Veiled Wealth. Stay sharp, watch the data, and I will see you in the next one.